Oil prices a little bit lower this morning, although we're talking about some pretty high levels if you've been watching. I think last I looked, it was over $107 a barrel for WTI. Joining us right now to talk more about it is Daan Struyven. He is co-head of Global Commodities Research at Goldman Sachs. Actually, right now, crude is at 108.38, so we've moved up through the course of the morning. Brent's at 110.69. Don, let's talk a little bit about what you see happening here. Obviously, it's hard to figure out where we're headed on these headlines that change so frequently when it comes to the Middle East. How do you try and figure out where oil prices are headed?
Yeah, it's highly contingent on when supply from the Strait of Hormuz comes back. Our base case is pretty close to market pricing at this point. In the base case, flows start to recover pretty soon, and Persian Gulf oil flows normalize by the end of June. Then you end up at around $90 Brent in the fourth quarter. But clearly risks are skewed to the upside on net. Every month of delay in the supply normalization process is worth $10 of upside to prices by year end.
And that's because the drawdowns that we've seen from the strategic petroleum reserves around the globe, and just the idea that it's getting harder and harder to kind of juggle some of those demands?
Yes, that's right. So initially, the market has largely absorbed the largest oil supply shock ever with inventory drawdowns, both commercial and strategic inventory drawdowns. But the longer this lasts, the higher is the probability that the market shifts to demand destruction via significantly higher prices as the next solver.
You say it's not your base case, but you could see a situation where U.S. oil exports are restricted. Explain how you get to that theory and what it would mean for prices.
Yeah, so U.S. exports of both crude and petroleum products have surged. The U.S. is now exporting almost 6 million barrels per day of crude. And so that has helped to alleviate some of the tightening in the rest of the world. But inventories are drawing pretty quickly. If U.S. inventories continue to draw at their current pace, for instance, for the diesel market, our models would suggest that OECD commercial diesel stocks would hit levels close to estimated critical levels later this summer, for instance, in August. And if that's associated with significantly higher U.S. retail fuel prices, it is plausible that the U.S. would follow the path of other countries like China, Thailand, by either banning or restricting exports. It's not our base case because we do think that the U.S. administration is focused on supporting U.S. supply and supporting the position of the U.S. as the dominant energy producer.
So
but it's a risk case.
Right now, those U.S. exports have been helping keep prices lower than they would be around the globe. But if it gets too tight, meaning that prices go up too much here, you think there'd be political pressure that would make this administration and maybe others in Congress look at the idea of saying, hey, we're going to hold on to this for ourselves and let everybody else fend for themselves. It's
plausible, although eventually this could create negative effects for U.S. refinery production and U.S. shale production. That's a key reason why it's not our base case. But in an environment with rapidly drawing inventories, you can't rule that out. And we advise our clients to think about that risk.
Meaning buy now if you're going to need this? If somebody who can hedge on some of these things for longer term? So
if you were to see U.S. crude or petroleum product export restriction, you would expect a pretty wide gap between higher international prices overseas and lower U.S. prices, at least in the short term.
Does it work to hedge in any of these situations, or is there a force majeure that gets called in some of these cases?
We have seen some news articles reporting that some of the U.S. shale producers have actually hedged against the risk of a sharp drop in WTI U.S. crude prices versus international benchmarks such as Brent.
Okay. The idea of what's happening at the refineries right now, too, explain that. There's been obviously a much bigger price incentive to do things like jet fuel versus what they may have been doing before. Explain what's happening at the refinery levels and how we should follow.
It's pretty powerful. At the start of the war, the jet fuel market was clearly the tightest market with the greatest risk of shortages because the Middle East is a key exporter of jet fuel. But we have, for instance, seen U.S. refineries increase their share of jet fuel in refined products production from about 10% to 12%. So that's a 20% increase. It's a relatively small market compared to diesel and gasoline. And so this big supply response has been helpful to push back the timeline of reaching critically low jet fuel inventory levels. Now, the flip side is that this has likely come at the expense of production of other refined products. While initially the gasoline market was the least tight, the more refiners switch to jet fuel and diesel, the more this tightness spreads from heavier products such as jet and diesel to lighter products such as gasoline.